What exactly is Bitcoin mining and how does it operate? Bitcoin is a cryptocurrency that was created through the mining process and has sparked worldwide attention due to its severe price volatility. The process of putting new Bitcoins into circulation is known as Bitcoin mining. The process of manufacturing new Bitcoins by solving very tough math problems that verify Bitcoin transactions is known as Bitcoin mining. When a Bitcoin is successfully mined, the miner receives a certain number of Bitcoins. It's only natural that the price of cryptocurrency has climbed in recent years, so has interested in mining. The majority of the people, on the other hand, do not consider Bitcoin mining to be feasible choice because to its completely and high cost. Here are the principles of Bitcoin mining as well as some key points to keep in mind. Number 2. Understanding Bitcoin. Bitcoin is one of the most well-known cryptocurrencies, which are digital currencies that can only be used online. Bitcoin is built on a distributed ledger on decentralized computer network that maintains track of the Bitcoin transactions. When computers on the network validate and execute transactions, new Bitcoins are created or mined. In exchange for the payment in Bitcoins, these network computers or miners complete the transaction. The technology that powers Bitcoins as well as many other cryptocurrencies is known as blockchain. A blockchain is the distributed ledger that keeps track of all network activity. A blockchain consists of a series of permitted transactions linked together to form a chain. Consider it a lengthy public record that functions similarly to a long-term receipt. Mining is the process of adding a block to the Bitcoin network. Number 3. How Bitcoin mining works. Bitcoin miners complete the solve incredibly complicated method problems that need the use of expensive computers and massive amounts of power. In order to properly add a block, the computer hardware required in application-specific integrated circuits or ASICs, which can cost up to $10,000. ASICs have been chastised by environmentalists for consuming a lot of electricity, limiting the probability of miners. A miner will receive 6.25 bitcoins if they successfully add a block to the network. The incentive value of halved every 4 years on every 210,000 blocks. In January 2022, Bitcoin was selling at over 43,000, making 6.25 bitcoins worth approximately $270,000. However, Bitcoin price has been extremely fluctuating, making it difficult or impossible for miners how much their payout will be worth when they get it. Number 4. Is Bitcoin mining profitable? As a point of contention, even if Bitcoin miners succeed, the high initial equipment cost and ongoing power cost make it uncertain if their efforts would be profitable. According to the Congressional Data Service research from 2019, one ASIC may consume the same amount of power as half of a million PlayStation 3 consoles. Joining a mining pool is one method to share some of the hefty mining cost. Pools allow miners to share resources and boost their skills, but the potential playback is reduced because pooled resources means shared rewards because of volatility of Bitcoin's price. It's also difficult to know how much you are working for. Number 5. How do you start Bitcoin mining? Here are the fundamentals you will need to get started with Bitcoin mining. Number 1. Wallet. Any Bitcoin you earn as a consequence of your mining activities will be saved in the wallet. A wallet is a secure online account that lets you store, send, and receive Bitcoin and other cryptocurrencies. Cryptocurrencies wallets are offered from Coinbase, Trezor, and Exodus, among others. Number 2. Mining software. There is a variety of mining software providers, many of which are free of download and run on both Windows and Mac systems. You will be able to mine Bitcoin after the programs connected to the appropriate hardware. Number 3. Computer equipments. The hardware is the most cost prohibitive part of Bitcoin mining. To successfully mine Bitcoins, you will need a powerful computer that consumes a lot of electricity. It's not unusual for the equipments to cost more than $10,000. Number 1. Price volatility. The price of Bitcoins has changed substantially since it launched in 2009. In the previous year, Bitcoin has traded for less than $30,000 and around $69,000. Because of volatility, miners have no way of knowing if their rewards will cover high cost of mining. Number 2. Only a few countries have embraced cryptocurrencies like Bitcoin, and many more are suspicious of them since they operate outside of the official supervision. Governments might restrict Bitcoins or cryptocurrency mining entirely, like China did not like China did in 2021, claiming financial dangers, specula- increasing speculative trading as justifications. Number 7. Taxes on Bitcoin mining. It's critical to bear in mind that the tax implementation It's critical to bear in mind that tax implications of Bitcoin mining. The IRS has been seeking to crack down on cryptocurrency owners and dealers as their prices have soared in recent years. The most major tax consequences of Bitcoin mining are listed here. Point number 1. Are you a business? If you make a living mining Bitcoin, you may be able to deduct part of your expense from your taxes. Your revenue is determined by the value of a Bitcoin you earn. If mining to a hobby for you, though, you won't be able to deduct your expenses. Point number 2. Mine Bitcoin is income. If you are successful in mining Bitcoin or other cryptocurrencies, you will be taxed on the fair market value of the currencies at the time of receipt. Point number 3. Capital gains. If you sell Bitcoins for more than you paid for them, you have achieved a capital gain, which is taxed similarly to traditional assets like stock and bonds. Number 8. In conclusion, while Bitcoin mining may appear to be appealing, it's difficult to expensive to do a profitability. The tremendous fluctuation of Bitcoin price adds to the equation unpredictability. Remember that Bitcoin is a speculative asset with no inherent value, meaning it won't create anything for its owner and it's tied to anything like gold. Your profit is reliant on selling it to someone else for a greater price, which may or may not be enough to cover your cost.